right. All right. Welcome everybody to AMA. I think this is AMA number 9. Have a few announcements to make before we get to the meat of the lesson. It's not gonna be 10, 15 or whatever minutes. Hopefully, maybe 10. So I told everybody last month that the course is now gonna be offered for free. It's gonna be on YouTube. And the first lesson has actually been released today. I have to do a bit of polishing, not really polishing, but I do have to do a bit of work before the videos can go on YouTube. Transcripts for and the like need to be there. So it's going to start being released slowly over time. Now, you guys, all of you got to watch the first version of this course. I always said that I intended to polish the lessons and make them a little better as time goes on, and that process has started. So there's going to be all new versions of lessons 4 through 9 coming soon. I can't give you a specific schedule. I know that lesson 4 is going to be released on the 9th of May, possibly later because I do have to travel to the States in the first week of May for a conference at WISE. And so I don't have time to review and watch all the videos and work with the editors. But there's all new versions of lessons 4 through 9 coming this year. Most likely I aim to get all of those done. I will share the links. It's going to be on the Discord too. You're going to be able to see the new lessons. They're going to be graphics. It's going to be the same quality as lessons 1 through 3. So I actually highly encourage you to rewatch some of these. And again, it's going to be on YouTube. You're going to have links directly on the Discord. I'm also going to be doing a podcast with Max Wright. Some of you know him, some of you follow his channel. Love the guy. We're going to be talking next week. And this is when I will publicly announce that everybody on everybody on YouTube, everybody with an internet connection can actually take the course now. Slowly, I'm going to start bringing in people to the Discord. Slowly, initially, there are not going to be any public links or anything. I want to grow this very slowly initially at first. I have some plans for expansion, but that's way down the line. So I'm not even going to go into that yet. But for now, it's just want to test out what feels right, what doesn't feel right, but slowly grow the group. You all are going to be everybody that has already joined in this Discord is going to be promoted to a founding member. A founding member means that you're going to have access to everything I publish, whether it's behind a paywall or not, from here on out. So that's a bigger announcement. Anything I publish, you guys are going to get access to that. What else? I think that's it. So look for that video to come. I don't know. I think Max publishes them a couple of weeks after we shoot the podcast. So, and then yeah, slowly people are going to start joining the Discord. If you know anyone who might be interested in the course, they want to take it, go ahead and talk to them about it. Share a link with them. Again, for now, the way to join the Discord is to basically send me a direct message. There's no other way to join the Discord for now. I think I'm going to announce it next week. So I'm going to start getting requests, and eventually I want to create a process to filter out. Most people will be allowed to come in, but again, when you start growing something, you want to make sure that the quality stays there. So that's coming too. I have published on Hyperliquid, and I will share a link to that after this call. Also, the first trading strategy that is officially on mainnet, so you can actually deposit real money on it. Now, it's still in beta, in my opinion, still testing it out. So there's not a lot of money in there. If you want to join that pool and you want to trade alongside the pool. Again, I'm not involved in it at all. It's an automated trading bot. I have designed the strategies, but it runs by itself. You can join. You can deposit real money in it now, just not much. I don't think you can. I think it's like a $7,000 that I deposited in there, and so it cannot grow. Deposits cannot outgrow my own personal deposits, meaning that it can only take in $7,000 for now. But I would love to hear feedback if any of you are interested in following that strategy. Any feedback on what do you think about it? I mean, so far it's doing pretty good. If you go on Hyperliquid and you watch the P&L, it will say that it's down X amount, X percent. That's not really true. The reason it's down is because I created that pool months ago. I did a bunch of tests on it and everything crashed, so it ended up losing money. But as I launched this pool, all the trades that have been placed by the trade bot have been so far profitable. But again, it just tracks the market. So if the market's up, it's going to make money. If the market's down, it's probably going to lose money. It's just not going to lose as much. That's basically how it works. Um, Thanks, Natasha. And I think that's it. If there's anything else that I haven't mentioned, I'll mention it in the Discord. Just know that you're all gonna be promoted to a founding member. So you're a member now, and I don't even know how Discord works. I gotta actually polish my Discord skills. But once I create that founding member tier, you're all gonna be part of that. And founding members, like I said, anything I come up with, you're gonna have access to that. And yeah, I encourage you to watch the new lessons as they come. I'm going to announce each and every single one that gets published. They take anywhere between 3 weeks to 3 to 6 weeks to do a single lesson with the graphics and all the editing. So it's quite a bit of work. And so, and I'm doing a lot of work on the timing model itself, launching strategies, and I'm going to have email alerts soon. Again, going to announce that you're going to start getting them. I will need your email, but if you're interested, you're going to start getting them within a month. You're going to start getting trade alerts on the 10 or so crypto assets that I run the model on. The one thing I ask you to do, just a favor, if there's any asset that is not on the list of traded assets for my timing model, please submit it. No altcoins. I mean, I know that maybe some of you want to trade, Bitbook here or some meme coin. The timing model that I have that works is based on the cycles model that I teach in the course. That model is best to run on assets that have at least 2 years of trading history. If it doesn't have that, then I cannot optimize the strategies and I cannot vouch for its reliability. So if there's something you want to trade and it's not being covered in the 10 or so, I think it's 10 assets that I have that I'm tracking right now with the timing model. But again, if there's something that you think is cool that might be good to deploy the model on, let me know, because I also want to expand that list. But everything is being rolled out slowly, mostly due to time constraints. I'll be honest. I mean, I have a day job and I'm doing this on the side. But eventually going to start growing. And I think people will like it. So hopefully you do as well. So let's get right into it. I see that more people have indeed joined. Perry, good to see you, my friend. Margot, great to see you. Let's see. Let's start with TradFi. Let's start with the S&P 500 because I don't think the market was crashing as hard as it was. No, because we did this in late March. I think it was on the 25th. One final announcement. I want to start doing these AMAs on the 4th Friday of each month, which is options expiration day for crypto. That I'll send everybody a reminder of that on Discord, and I'll create a poll for that because I feel like otherwise my schedule is too chaotic, and we always end up doing it around the 4th Friday of the month. But I want to make sure that everybody knows that the 4th Friday of the month at 10:30 a.m. EST, unless there's some specific reason I can't make that day, that's when we're going to start doing these AMAs, if you all agree. But again, I'll create a poll for that. Anyway, so let's jump right into it. Last month when we were doing the AMA, we were going over the S&P 500, and I was showing you all this double VTL rule that I have for the stock market. Basically, the double VTL rule, just as a quick reminder, I have the lows highlighted here. It's basically what we do is remember there's a 20-week cycle in the stock market. And what we do is we take 3 of these 20-week cycle lows, 3 consecutive lows, and we draw the 2 VTLs that we can draw using those 3 lows. And what we have is this. We have 2 VTLs. So we have 2 VTLs, 3 lows, that gives you 2 VTLs. If the stock market crosses below both of these VTLs, it is said to be in a bear market. It's a way you can, what I taught in lesson 4, which again, I'm reworking, it's coming soon in a couple of weeks. What I taught is that you can short the market when that happens. You can see that once again, that it worked pretty well. I believe what I said is you want to make about 10% on a trade like this. I think we did have a 10% crash on that double VTL crossover. Yeah, over 10%. This is the most you can squeeze, in my opinion, out of a down move in the stock market, unless you're going into a full-blown 2008 style global financial crisis. You're not gonna make more on the short side of the stock market. I think the reason a lot of people, because shorting is popular for some reason, I think the reason people like to short stocks is the instant gratification feeling. You get this signal on, you get it on March 10th, and within about a month, you're already up 10%. Of course, you're going to add leverage on top of this, hopefully, because your risk would be that the market makes a new high. So this case, well, you're risking one to make one, really. Once you have this rally here and then another sell-off, you can actually short again and potentially lower your stop down to this cycle high here. And that will bring your risk to maybe 3% or something like that. Let's say you reshort, you wanted to go short again here. So that will give you 4%. Maybe you can double that position. It's kind of like a 2-to-1 trade. I'm not a big fan of these, by the way. I don't take these trades, but again, I wanted to show people, students, how they can short the market using a very simple cycle strategy. There's obviously other ways or other indicators you might figure out how to use to go short stocks, but this one's pretty reliable. I mean, every time these two consecutive VTLs get crossed over, the market crashes. Not, I would say, every time that I've seen, every time since 2000 or so. I would need to develop code to actually test this out going beyond, going back further than the year 2000. That's what I've done manually. It works every time, like every time. It's one of those things that it's pretty reliable, pretty consistent. So it triggered again. Beyond that, my timing model, which does run on the stock market, when the double VTL rule is crossed, it switches the trend on the stock market to bearish. So it is set to be, the market is set to be in a bear market. There is an exception to that though, and I kind of alluded to that last month, but I want to go over that a little bit because I am watching this. The double VTL rule, the ideal rule is something like 2015, the China devaluation. I think it was China devaluation back then. So you have, let's see, let's draw these VTLs. So you have here, we have one here. And I think the next low, you know what? Let me fit this to the actual price. So I don't want to make a mistake. There we go. Okay, so the next one is here. This is the double VTL in the case back then. So ideally, once the first VTL is crossed, which is sometime here, there we go. Sometime here, you don't want the market to rally too much. How much is too much? 2 to 3%. So you don't want the market to rally to new all-time highs and 2 or 3% prior to the last high. So in this case, we have these two cycle lows, and then we have the high that follows here. And notice that the market is kind of flat after that. It's just trading sideways, and then it breaks another VTL. This is the ideal double VTL setup. In other words, we have a VTL crossover. The market doesn't really rally that much. And then we have another VTL crossover. And of course, the market crashes. Now, this in my computer model is set to be a bear market. And notice that the second VTL is crossed around June of 2015. The low isn't hit until February of 2016. So that gives you basically, it's most of the year. It's the second half of 2015, a couple months into 2016. So it's a few months of bearish price action. That's what I've seen. This is not an isolated example. I did go over that in lesson 4. I didn't go over all of the examples since the year 2000. There's actually not that many. I think you have the one in the 2002 through 2003 bear market. I think there's one there. There's a double VTL. So this bear market here, this is the Y2K bear market, and that one got triggered with a double VTL. So you have the first one here. Let's see, where is it? Didn't quite cross this one. Oh no, actually it did. Here we go. It did cross. So we got the crossover here in typical cycle fashion. This happens a lot. The VTL is crossover exactly at the time of the low. That happens a lot. Happens in crypto a lot. But this counts as a crossover, especially in the stock market. A single close below that VTL to me counts as a crossover. There's not a lot of noise in the stock market because it's a big asset class. So you have your first crossover here. Let me highlight the first three lows. There we go. And then we draw the second one, which is basically it's almost a copy of the first VTL, slightly more, slightly flatter. And then you have the second crossover here. That's your bear market signal. And notice that we just go straight down from there. That's your bear market right there. So this can't happen. It doesn't always happen. Usually it's what we saw in 2016, 2015. But it can also be a precursor to a meaningful bear market. And notice that once we cross the first VTL, this is the ideal setup. Once you cross the first VTL here, you have this high. This is the all-time high at that time, at the time of the crossover, and the market never actually rallies above it. Now, in my testing, I have seen that it can rally slightly above, so it's okay if prices go a little higher. They make a slightly higher high, up to 3%, I would say. That's okay. That's considered like a flattish type of trend. And then you have our second crossover and bear market signal. 2008 starts the same way. There are no more double VTL crossovers in this entire time period. There's no more. The next one is here. I believe it's here. Here we go, like that. And no, that's the second one. First one's here. So that's 2008. You have the first crossover here. And then you have, notice that the market does rally to a new high, but slightly higher. That's okay. You're still in the classic pattern that the market is not really rallying to new highs. It doesn't negate the pattern. And then you have your second VTL crossover right there. Market rallies, doesn't really matter. It's already going into a bear market by then. These are, if you're wondering, the vertical lines are all the times the Fed cut rates in 2008. This is the effect. You can see that back then the effect was a short-term rally in the stock market. It didn't have much of an effect though. And then they started panic cutting here in October. That had no effect at all. I think the biggest cut that actually had an effect produced a rally of a couple of months. Market rally for a couple of months between March and May of 08 as the Fed was cutting. But deflationary forces, once they set in, what's the word I'm looking for? They overwhelm whatever liquidity boost you see in the global markets by virtue of the Fed cutting rates is completely overwhelmed by debt deflation, which is what happened in 2008. And I think it might happen soon. That's why I'm going through all of this. So I'll get into that in a second. So this is your classic VTL crossover, double VTL crossover, and then we have a bunch in this bull market from 2008 through to the present. We have a bunch of them. Here's another. This is the classic one. Again, classic setup. Notice that using filters, we can go back to some 20-week cycle low that took place in August of 2010, and then we're connecting that with something that took place in March of 2011. That's okay. We're just using filters here to keep it simple. And in my experience, the pattern still holds. So again, another classic setup. You have the first VTL crossover. The market does not make new highs. Then it crosses the second VTL, and you have a quick crash. I do remember going through this in lesson 4. Then we have the one from 2015 here. We just went over that. Then we have the weird patterns, which I've not seen before. So here's the one in COVID. And the thing about this, when we went over it last month, is that we do have, I didn't think we had a double VTL crossover, but we do, except that the market does rally strongly between the two crossovers. So here's the first one. This takes place on this sell-off here. Again, VTL is crossed exactly at the time of the next 20-week cycle low. This happens a lot with cycles. I don't know why, but it does happen quite a bit. The signal is still valid though, as you can see. So here's the 20-week cycle low. We also have a crossover of the 20-week cycle VTL. Then the market goes on to make, it just proceeds to make another significant cycle high much later. But if we draw the next VTL, you can see that it's still crossed below it. So technically we do have 3 consecutive 20-week cycle lows, and the market did cross below both consecutive VTLs. What we have is a crash. We don't really have, I don't consider this a bear market because this is just a quick crash. And then it's off to the races again. They start printing money in March of 2020, and the market traces out a V-shaped bottom, rallies strongly. The next time we had a double VTL crossover, it was a classic pattern again. So it was, we're connecting these two. And then the next VTL is here. But in this case, because the VTL has, I don't know what the term is in English. I think it's like negative, it's a negative angle. Because we have a negative angle, we can actually replace the VTL with just a horizontal level. We went over this last month. So, but this is the classic setup. So the weird thing is, up until 2020, I hadn't really seen this type of setup where you have the VTL, the double VTL crossover, but the market actually does rally to a new strong all-time high in between. Now, in my computer model, this completely negates the double VTL. If the market rallies to a new all-time high, it negates the bear market signal. However, the market did still crash in March of 2020. We have the same setup now, or we had the same setup. We have a double VTL crossover, but the market is rallying and making new all-time highs in between across. No, technically, no. Actually, now that I'm looking at it, it's not really the case. The market does rally strongly between these two cycles, but at the time the VTLs were crossed, the market didn't really rally to new all-time highs. This is not exactly what I had in mind when I came up with this rule, but you can see that it does work. It did still work. And so this is kind of in between. I would not call this a classic pattern because typically when you're connecting when you're taking 3 consecutive 20-week cycle lows to create this double VTL rule, what you want is basically a 20-week cycle low that comes after the first of these VTL crossover. So that 20-week cycle, we will be looking for it right now, and the market breaks below it. That's your bear market signal. So this is all to say, all to show you that it seems like this double VTL rule works beyond the use cases that I tested out and I taught in lesson 4. But beyond that, we have a setup now, regardless of whether or not we consider this current setup with these 3 highlighted lows as a bear market signal. I don't really, this is not exactly the pattern that I had in mind. Again, and specifically, this is because the 20-week cycle that I'm looking to draw a VTL from would come after the first crossover. So the first crossover took place on February 24th. So in order to set up the classic setup that I have tested and that I know works, we would need a 20-week cycle low that came after February 24th. We don't have that yet. So we can't actually apply this rule. However, it does seem to have worked. If I connect these two lows, I draw a VTL, I connect the next 2 lows, I draw another VTL. Once that's crossed, you get your 10% trade. So at the very least for trading, it does seem to work. But beyond that, it does look like we have a 20-week cycle low probably here on April 7th, which funny enough, it lines up with the forecast that I have on the Discord for 2024, for 2025 in crypto. So the stock market and crypto, they did line up here. This is not the first time I see this. Usually when I have a very important forecast in crypto, that tends to ripple across other asset classes. I'm not saying that what happened on April 7th, this crash was that the epicenter was crypto. It absolutely was not. But because these forecasts are based on geocosmics, it does seem to me that when I have a very high intensity reading on that forecast indicator, that means that something's going to happen with the world. So those turning points, they're not just for crypto, they're for other asset classes as well. This is a long way of saying this is probably a very important low in the stock market as well, here on April 7. And if that is confirmed as a 20-week cycle low, you can draw this line here. Let's make it red. If that's confirmed as a 20-week cycle low and prices were to cross below that, now we're in the classic double VTL setup. This is the classic setup where we have the first VTL crossover. Let me just delete some of these to make it a bit more clear. We would ignore this one. This is not the classic setup. But now we have the makings of what I call, or my computer model calls a bear market, an actual bear market, because you have the first VTL has been crossed over. Now we're tracing out a 20-week cycle. And if prices were to cross below that 20-week cycle, again, the reason I'm using the horizontal level, let's make this red, paint this red, there we go. The reason we're using the horizontal level, not the VTL, is because the VTL has a negative angle, like this. We don't use that. When we have a negative angle, we use the horizontal level instead. And yes, I have tested that in commodities as well. It works pretty well. So the negative, if a VTL has a negative angle, don't use it, just use the horizontal level. So this low is critical. If the stock market does not hold that low, then I think we're going into a pretty significant bear market here. I don't know if it's gonna happen, by the next time we do one of these AMAs. You've already seen that even in 2008, we would have rallies that would last longer than 60 days. So this is very much true in the stock market. What I'm watching now is for the trend to stabilize. But that low on April 7, keep an eye on it, because if the market were to fall below it, and it could fall below it, in the second half of the year, it doesn't really matter. If this is an important low, like an 18-month low or something, that's okay, as long as prices stay below the all-time high, this triple top here. As long as we're below that, I would say the triple VTL rule is still valid. And so that low, that red line, is pretty significant. We could be going into a bear market. I don't think it's going to happen necessarily now in 2025. But if the market just treads water between the April 7 low and the triple top here from January, then we could be setting up for a more meaningful bear market. Just to recap here, we have this double VTL rule that was triggered, but it's not the classic pattern. It's not the pattern that I envisioned. We do have 2 consecutive VTLs being crossed, but they're both generated prior to the first VTL. So the second VTL, it actually came before this current. So you notice that the first VTL that's crossed over, that this is the later VTL. This one was the older VTL. So this is not the classic pattern. It seems to work still, but I just don't. I'm not going to call for a bear market based on this pattern. However, if prices were to fall below the red line, the April 7 low, yes, I would say we're pretty much in a bear market in stocks, which means everything else is probably in a bear market as well, because everything trades with the stock market. The U.S. stock market is a proxy for the globe and the global financial markets, the health of those markets. And so if this market is sick, everything else is sick also. And in our little corner in crypto, probably gonna suffer the consequences of that as well. So this is the first thing I wanted to highlight this month. Let me read some of your questions before I move on. So Perry, thank you for your questions, good sir. I do want to, now that Perry has shared the forecast here, thank you for doing that, by the way. Notice that April 7, I only realized this when I went through the index that I have. I shared the data for the index in the forecast 2025 section of the Discord. But once you go through that, you're going to notice that the highest intensity reading for a low was actually April 7. It's a reading of 3.2. It is the highest reading for a low in all of 2025. So I have to apologize. I actually missed that last month. Perry, I think you asked me about April 7, and I sort of dismissed it as, the low is probably on March It probably took place on March 11. When I looked at the actual readings of those forecasts, and I noticed that April 7 was the highest intensity reading, I was like, oh no. I mean, we can clearly see here that April 7, between March and April was the more important turning point, and indeed it was. So yeah, still thinking of how to, as I shared before, I'm still thinking of how best to display that data, because when you just have a list with numbers, you can miss the fact that, yeah, early March is an intensity reading of 1.2. April is 3.2. And yes, that reading matters. The actual number is very, very important. And readings of 3 or above are very uncommon. You usually don't have those. So my bad. I should have been looking at April 7 as the low, which we're going to see in crypto was also the low, which I think was a 16-month low in crypto. So yeah, I'm just learning like the rest of you guys. So yeah, S&P has that horizontal level around psychological number of 5,000. That's coming from Perry. Yes, you're right. It's 5,000. I think it's going to be proven to be more than a 20-week cycle low, Perry, to be honest. That's based on the forecasts for 2025. It does show that it's a very significant low, not just a 20-week cycle low in the case of the stock market or an 80-day cycle low for Bitcoin. It's probably going to be more significant. So this bear market setup that I'm highlighting, it may not trigger at all if this is indeed a more significant low, but it could. It could. It's not every year that you have this double VTL bear market setup. Uh, it's very uncommon. I just showed you since 2008 we had it 4 times, 3 times don't if you don't count the 2021, we only had it 3 times. So including this one, by the way. So it's not very common. So every time it happens, it's worth highlighting. Sorry, no, we had it 3 times. We had it in 11, 15, and 2022. That's the classic path. We had it 3 times, and there's like an extra bonus with COVID, and then now this one. It had a noticeable wicks below it already too, and then on that recent drop. Yeah, so 5,000 on the S&P, that's a critical level. I think if we drop below that, especially within the next cycle, within the next 20 weeks or so, we're talking about, well, it's probably a bear market at this point. At that point, we're probably talking about a bear market in the stock market, which I think is going to happen between now and February 2026, because yeah, that's when things get heated up. So not only are we seeing the pattern unfold, not confirmed yet, not only do we see it unfold, there's also some indication that we may actually go into recession next year. So yeah, the stock market seems to be signaling that, which is why I've been quite pessimistic on what's going on with the Trump trade wars and all that. I don't want to call it Trump's trade war, but it kind of was instigated by him, an unforced error, if you ask me. The way this is being done is a little ridiculous, and it's having a negative impact on world markets. Now, the market was already weak and the economy was already weak to begin with, but I don't think it can stand this blow. And the blow is not the tariff itself, is the uncertainty that it creates. There's just uncertainty. Nobody knows what this guy's going to do. Nobody knows how China is going to react. Nobody knows anything. And what does capital do when there's in the face of so much uncertainty? It pulls back. That's similar to what happened in 2020. Actually, we had global lockdowns, a lot of uncertainty. It was far worse than what we have now. I want to be clear about that. But it was quite similar in terms of creating massive amounts of uncertainty. Back then, we had central bank support. We don't really have that now. And so, even though it's not as bad fundamentally speaking, the fact that liquidity was moving sharply higher in 2020 and 2021, whereas now it has been moving higher, but not sharply, and maybe contracting in the second half of the year, that might be enough. This amount of uncertainty on top of the weakness that was already on top of that was already afflicting the global economy, have a weak economy. Now you have massive amounts of uncertainty, and you don't have supportive monetary policy. That's the recipe for recession. So maybe I'm wrong. Maybe nothing happens. But it is a recipe. The ingredients are there. It's just a matter of mixing them in the right way, and you have a bear market in your hands. All right. So if only I put the 3.2 on the model in highlighted yellow and bold and red double outline, Yeah, Perry, I do have to apologize for that. You did ask me about that in March, and the answer was not satisfactory, even to me when I looked at it. Um, and I actually looked at it in the first week of April as the crash was taking place, and I looked at the chart, not not the numbers, but the actual chart with every value. Every day has an intensity reading, and I'm only showing the peaks here. I only share the peaks on that chart. But when I looked at it visually, I'm a visual kind of person, and I like looking at charts. When I looked at the chart and I saw that the highest peak was April 7, I was like, what am I talking about? Why was I thinking that March could be an 80-day cycle low when I have a much higher likelihood of 16-month and 80-day cycle lows on April 7th? And April 7th is exactly when this low took place, to the day. So there's a double bottom on that too. I think you can see it in the stock market as well. You have an attempt to cross below the April 7 low on April 9, but it held both times. So that was the actual low. That's the low we should have been expecting. So my apologies. All right, question from Perry. So if the market crosses below a VTL and then comes back up to make a new all-time high, would it be prudent to manage risk to be out or at least tight stops at the old all-time high until it's past 3% above it, maybe trailing stop? Well, Perry, I needed to elaborate. Depends. If you're short, I would say if you shorted on the first VTL, um, then you should probably be out if you have a new all-time high close. If you're long, I don't advise you to do anything when one VTL is when prices cross a single 20-week cycle VTL. There's a lot of examples. Just there's one here. If you just draw a 20-week cycle VTL and prices drop below it, in my experience, it doesn't mean anything. It means nothing. You need two consecutive VTLs to be crossed in order for that to mean something. Now, if you're long and you see those two VTLs being crossed, is that a good time to take some profits? Yes, absolutely. I don't know if that was your question, but if it is, yes, absolutely. Two VTLs being crossed, single VTL being crossed doesn't mean anything. If you have two consecutive VTLs being crossed, prices crossing below two consecutive VTLs, yes, that's a great opportunity to take profits. But that's all it is. It's not a short signal. You should not go to cash. You shouldn't do any of that. It's not something you dismiss, but it's also not necessarily. Sorry, if you have the two VTLs being crossed, you should probably go to cash. If you have a single VTL being crossed, you shouldn't do anything. That's basically what you should do. Initially, I had a trading strategy that I would go to cash every time the market crossed below a single one of these 20-week cycle VTLs. That's not a good strategy. It's not a good approach. Most of the time, when these VTLs are crossed, absolutely nothing happens. In fact, they're usually crossed, as I just mentioned. These VTLs are usually crossed at the time of a 20-week cycle low. So the stock market tends to cross a 20-week cycle low VTL at the time of the next 20-week cycle low. It does that a lot. So be careful here. I mean, I showed you a bunch of those examples. You can see another one here. Market crosses the 20-week cycle VTL, and within 2 days, we have a 20-week cycle low. That happens a lot. But if you have two consecutive VTLs being crossed, yeah, that is quite significant. It seems to mean something. So yeah, I need to explore this further. But I would say is, yeah, if you have two consecutive VTLs being crossed, pay attention. If you have a single one, ignore it. So does your model forecast consecutive highs, two in October, November, possibly have an accumulative quality, i.e. stronger, perhaps about three value for the actual high in that time range? Let me see. So above two in October. Yeah, we have a bunch in October, I think. We have November 2, 3, and 4. We have a reading of 2.4 on the highs. Just looking at it here. We have late October 2.3. If you ask me, in this, I don't know exactly. I don't know that indicator. I know it works. It keeps working, so it's almost magic how accurate it is. If you see a cluster of high intensity readings, that probably produces a 16-month high. So I'm expecting a 16-month high in October, November. The reason for that is, well, there's a couple of reasons for that. Number one, assuming the low was on April 7, then the next high would be in the October, November time period. October and November also happens to be when the 4-year cycle in crypto usually tops out. It can be as late as December, maybe even early January. Usually it's November, December. That's when you need to start looking for 4-year cycle highs. 2025 is the year of the 4-year cycle high. So just reading those forecasts, it would seem to me that there's a possibility that we have a 4-year cycle high. Just reading the high intensity dates, it could be in June, that's 2.1. Could be in August, we have a reading of 2.7. But these are based on 80-day cycles. So at most, they can help us find the next 16-month turning point. I don't know if you can use them for 4-year cycle turning points. So that's a long way of saying, just based on the seasonality of the 4-year cycle and looking at the forecast for 2025, I say we're very likely to see the next 4-year cycle high and 16-month cycle high in late November, based on those readings. It could also be early November, could be late October. That time period is highly sensitive for a 4-year cycle top. Probably going to be late November. Hopefully, I mean, if it is late November, then Bitcoin's going to 150, 160,000 before it tops out. Before I go there, though, I want to go on to, let's go to oil. Only reason I want to discuss oil is because on April 4, again, we have an important low here on April 7. But the most meaningful development on the oil market, I don't trade this one very much, very noisy. It also doesn't do much. But notice that we have this 18-month low from March 2023. When I recorded the lesson on oil, that was the last 18-month low. And I said, well, it looks like oil could either rally past 120, and that would be a buy signal, or it could sell off below 65, which at the time was the last 18-month cycle low. I think we have another. I don't have the filter on this one, but I think we have another of these. If you remember, I think lesson 5 is oil, or lesson 6. Was it lesson 6 or lesson 5? I don't remember. Regardless, if you remember, I said that there's an 18-month cycle in oil, but that can be anywhere between a year and 18 months. And so back then, or even less than a year, actually. So back then, I think we do have an 18-month cycle low here in December of 2023. And I believe we have another one here. But again, I haven't run the filter on this. So I don't know where those turning points are. It could be that this is not a turning point, and this one is. Regardless of that, there appears to be, there was, just even if you're not a cycles analyst, the 65 level is pretty strong support. And what I taught in that lesson is if oil moves below the 18-month low, that is a signal to go short. If it goes above the high, that's a signal to go long. And look what we have. We have a crossover of the 18-month cycle low, regardless of where it is. I mean, if it was here in December 2023, we're below it. If the actual low is September 24, we're below it. Just based on timing, I would say I would use this pacing here. I would say we have a low in March of 23, and then the next low is September 24. That's about 18 months. It's not really, it's a little shorter than that. Oh, wait, is it? No, it's almost exactly 18 months. So that will be the low for me. And notice that it's a double bottom at around 65, and we're below it. So we're below. And again, even if you say, well, there's a very short 18-month cycle low here, even if you say that, we're still trading below it. So short signal on oil. That's quite interesting. I don't know how low it can go. That's why I'm starting to get worried, because this $65 level has held for quite some time, and now we're below it. I mean, the first of these lows was in March of 2023. You have a second low in September 2024. And New lows, finally. So that is a recessionary indicator. Usually oil trades on demand, not supply. That's based on my experience. And I'm not an expert. I'm not an energy trader or an expert in this field. But I can't help but notice that as the economy weakened, oil was making lower highs and lower lows, um, even on its 18-month. So look at this. We have 3 consecutive lower lows on these 18-month cycles. Let's use all three. So we have consecutive lower lows, lower highs, and then we have this triple bottom. You can consider that a triple bottom, I suppose. And so you can see that it's getting weaker and weaker. Now, finally, we're below it. Another recessionary indicator. Again, I'm not saying the economy is going to roll over now or the stock market is going to roll over now and make new lows or crash or anything. Don't think that's actually happening. We were just discussing when the next 4-year cycle high is. I don't think it's in the first half of the year. But we're starting to see some recessionary warnings, let's just say. So it's something to keep in mind. I don't think it's something to worry about here in the first half of 2025, but it could start to be something to notice or to pay attention to in the second half of the year, which is when I think the next important top takes place on the 4-year cycle in crypto. And so I do most of my work in crypto, as you know. And if I think crypto is going to rally into the second half of the year, I don't think any of these markets, stocks or oil are going to roll over and crash or have any significant down moves. Module 6 is oil. Thanks, Perry. So yeah, on oil, if you go there, I actually tried to come up with a good trading strategy that used a 20-week cycle. And you can use it in combination with the 18-month cycle, but the one that's really a reliable indicator for trend in the oil market is definitely the 18-month cycle. And the 18-month cycle now officially on oil, regardless of how you face this cycle, is negative. We are making new lows. So that's pretty significant. That is a short signal, you know, quite reliable based on the studies that I did for that lesson. So I think about inflation on prices too. So oil, this is coming from Perry. Think about inflation on prices too. Like oil should be higher than the past just because of inflation alone. Agreed. So if it's the same price or lower, that's even worse. Yeah, adjusted for inflation, the fact that oil is at 62 and change today is, yeah, it's a sign that we're probably going to go into a deflationary recession. Again, I think it's going to really unfold in 26, but we may be seeing the earlier signs of that now in 25, especially as we approach the June-July time period. Finally, we have gold. Now, gold is, I don't actually have an update on gold in terms of what I covered in lesson 5, which is actually, I don't know if I mentioned this before, but lesson 5 on gold was my favorite lesson of the entire course. It was the most fun to record. And it's the only one that has an actual prediction that came true within months of recording the lesson. So yeah, I'm kind of proud of that. I'm gonna be redoing it. Perry, I don't know if you joined when I made that announcement, but I'm reworking all of the lessons. So you're gonna start seeing new versions of lessons 4 through 9 over the course of the next year. I can't promise that I'll stick to a schedule on that. It's not super high priority, but I am getting those done. We are now working on lesson 4, and after that, we're going to move on to lesson 5. At the very least, I plan on having the TradFi lessons ready to go by, say, August at the latest, and then the crypto lessons may take a little longer. Anyways, but what I was saying on gold is why did I delete that? That's exactly what I want. There we go, 7-year cycle low. So we have a 7-year cycle low here. That's what I said when I recorded the lesson. Still true. It's been more than confirmed since. Keep in mind that I recorded that lesson in October of 2023. So this is when I recorded the lesson. It wasn't obvious at the time that October 22 was a 7-year cycle on gold. But if you zoom out now and you look at what happened since, it's pretty obvious now that was a 7-year cycle low, which means we have higher prices between now and I would say 28. We have higher prices, higher and higher prices on the gold market. The beauty of the gold market is you have this 7-year cycle, And then the next cycle after that of significance is the 18-month cycle. That 18-month cycle will take prices down for a few months at most, especially during a bear market, like during a bull market like this. So it gives you many spectacular trades. Notice that I teach, there's a trade setup here on how to spot this 18-month cycle low here. That worked pretty well. You can buy here, you can buy gold here, let's say in October of 2023. And there's no reason to close that trade even today. No reason. Not only that, you have several entries. And the way to do that is I actually use the same FLD because it works pretty well that I use on for the 20-week, sorry, for the 80-day cycle in crypto. I use the same thing on gold, even though it's technically wrong, but it's good enough. It's a good proxy for a 20-week FLD. And so it's a 20-day displace. You move it forward by 30 days. I'm doing it wrong and fast. Here, watch lesson 4 through 6 for the actual FLD configuration. But this one works pretty well. Why am I using something that is right for an 80-day cycle in crypto for a 20-week cycle on gold? Pretty simple. I mean, I'm usually looking at Bitcoin. I'm usually going over crypto. If I want to see what's happening with the 20-week cycle on gold, I know that FLD is pretty good. So I don't have to change the settings. I can just click on the chart and there you go. Every time gold crosses below that FLD and then back above, that is a secondary entry on that upward phase of an 18-month, the upward phase of an 18-month cycle within the upward phase of a 7-year cycle. This is a very powerful trend. And the thing about gold is that unlike crypto, these trends last for years. We're only halfway through it. So we have at least another 3 years of rally. Possibly, I think gold might rally into 2030, actually, not 2028. So that gives you 5 years. So pretty good. There's a reason I want to discuss this though. You can see all these entries. All of them worked. That's usually what happens during the upwards phase of an 18-month cycle within the upward phase of a 7-year cycle. So these trades just work. It can be a little early here, but it still works. Or there's another entry there. That's the last time I bought gold. Bought it here. Haven't sold yet. I will sell when prices cross below the FLD, but a lot of people have been getting bullish on gold. I mean, every time I go on Twitter or on X, everybody's talking about gold. Gold is a new Bitcoin. Gold is doing what Bitcoin was supposed to do. Nothing can outshine gold, blah, blah, blah. Too many people getting bullish on gold. Also, I've noticed that a lot of crypto exchanges started listing gold derivatives, the gold stable coins. So gold trading is starting to get very, very popular. Everybody's talking about it. On top of that, I have forecasts. I have the same forecast that I do for crypto. I do for the 18-month cycle on gold, specifically the 18-month cycle, because that is the it's a pacemaker of the gold market, in my opinion. That's the one. It's not the 20-week cycle that you want to pay attention to if you want to know what the trend in gold is the 18-month cycle. So I try to forecast those 18-month cycles for gold. And I have a forecast that goes from 2024 through 2028, which is when I'm expecting the next 7-year cycle top. Well, one of the most significant forecasts for an 18-month high, one of the more significant dates for an 18-month high is late April 2025. So I've been waiting to see what happened around late April, around this time on gold. And sure enough, not only did it go parabolic, everybody got way too bullish, and now we're kind of seeing it go down. I'm not going to say this forecast was confirmed. I don't think it's confirmed yet. You would at least need to see gold fall below this FLD and possibly much lower than that. I would even go as far as to say I would like to see gold cross below the this last 20-week cycle VTL. So we're talking 2,800 or so on gold. And so I'm looking for a more significant correction in the gold market this time around. The reason I'm flagging that is you have a short signal on oil. We also have a reason to expect a pretty meaningful correction in gold which is definitely something you can buy into. That's what I'm waiting for now. I will probably sell my entire position if we cross below this red line. Again, this is just a 20-week cycle FLD that I use for crypto. You can use it as a short-term indicator for gold. And so, if you're up massively, as I am on my position, this is a good time to get out based on the forecast, just based on the fact that April is likely to produce the next 18-month cycle top. And if that pans out, if that materializes, that cycle sell-off as the 18-month cycle turns down, it's going to take prices probably below 2,800. And that's another buying opportunity. I don't know how much gold usually drops in a bull market on that 20-week cycle, when that 18-month cycle correction hits, but it should be more than 10%. Which is probably 15%, probably 10 to 15% if I had to guess. Just a wild guess. I don't actually have the numbers in front of me, but it should at the very least cross below this black line, this 20-week cycle VTL. At the very least, it should do that. I'll have an update on that next month, probably, or if I see an entry, I'll flag it on the Discord because these are slow cycles that they're worth paying attention to. If you're used to trading crypto, trading gold it's like easy mode. It's so slow, it's so reliable that it's actually easy to trade. So I flagging that because it seems important. And I don't know how I did an hour on TradFi, but hey, this is TradFi. I guess it was TradFi month. Before we move on to crypto, the bread and butter, just gonna go over these charts. Kind of I haven't actually done an extensive cycle analysis on the treasury market, but I do have these. I do have these on my watch list: the 2-year, the 10-year, and the 30-year rates. I also follow the Japanese 10-year rate as a benchmark. Um, Rates they have not come down. Basically, and you probably have heard other people flag this as well. We have a crash in the gold market. Sorry, on the stock market, we have oil crossing below that critical $65 threshold. I would have expected rates to be down, at least down some amount in the same time period, but they're not. I mean, rates did come down in early April, but then they snapped back up. This is the 2-year. The 2-year has been the weakest, so it has come down somewhat since the whole crash took place in early April. 10 years up. So it actually moved higher since the Liberation Day, since the Liberation Day announcement, which is what kicked off this whole conundrum. So the 10 years higher, not lower. That is super unusual. I have not been able to find any good charts that go back at least until 1980 to see how often you see, the dollar move sharply lower and rates move sharply higher. That's what happened in the first week of April. That seems unusual. I know it hasn't happened in the last few years because it's highly unusual. Usually, dollar weakness means rates come down because there's higher dollar liquidity and there's capital moving into the United States. So if the dollar comes down, that actually means capital tends to move into the United States because foreigners, when the dollar comes down, foreigners who sell into the US get more dollars and they recycle those dollars into the treasury market. So if the dollar is weak, the yield curve flattens, or it doesn't flatten, but yields come down. The dollar is strong, the dollar is tight, dollar liquidity is low. That tends to drive dollar rates up. That's the usual relationship, and it makes sense. If the dollar is strong, there's less dollars spread across the rest of the planet. Less people are buying treasuries. The dollar is down. There's more dollars in the financial system. More people are buying treasuries. Yields down. So dollar down, rates up. That means foreigners are dumping treasuries. That's basically what it means. That means capital is leaving the United States. So you have a crash in the US stock market. At the same time, the treasury market crashes and the dollar goes down. That usually happens in emerging markets. I mean, I come from Uruguay. I get tired of watching like the Brazilian stock market and treasury market, debt market actually, or Argentina. You usually see this in an emerging market. I mean, you saw it in Asia in 1998. People were selling Asian bonds and they were selling the Asian currencies too. This is usually how it works. except the US. The US is different. There's an inverse relationship. I think they call it dollar smile. There's an inverse relationship between the strength of the US currency and its debt markets. That's because the US Treasury market is considered the world's safest asset. It is the world's safe haven. It is the underlying foundation of the global financial system. So to see this type of price action is quite worrying. It does mean, however, that if rates continue to go up and the stock market continues to weaken and economic data starts coming in bad, which I hear it is going to start shipping data and global trade are way down since the tariffs were announced. All these things happen. We may see the Fed lower rates. That might bring in a bit into the treasury market. That might actually increase the supply of dollars, which increases global liquidity, which makes crypto fly. So I'm hoping for that. Just flagging this because last time we saw something like this was like in 2020. The stock market was crashing, the dollar was surging. Unlike now, the dollar is weaker. Back then, it was strong. But then at one point, we saw a massive crash in the US Treasury market. That's when the Fed came in. I don't think the Fed, I think the Fed is, I agree with the president actually. I think the Fed is kind of being a little political here. I don't think they want to lower rates because of the tariffs. However, if you read the economic data, these tariffs are going to bring in a deflationary recession, which means the Fed should be lowering rates. They should be cutting. They should not be holding the rates higher, saying, no, tariffs are inflationary, so we're going to hold rates steady or we'll see what happens. No, they should be cutting. I just don't think they want to help the administration. So that's all I'm going to say. I do think they're being a little political here because if you just look at the economic data, the Fed should be cutting. If you look at the fact that the dollar went down while rates went up, that means there's illiquidity in the treasury market. That's a reason to cut rates. So they may do it. They may do it within the next few months. And going to crypto, that's going to be if the Fed cuts rates. I don't think it's going to help the global economy. I don't even know if it's going to help the treasury or the stock market, but it will definitely help crypto. So we're going to crypto now. Yeah, we already talked about this. This is already confirmed to be, in my opinion, this is an already, let me turn this into a filter. This is probably already an 80-day cycle low in crypto. Notice that I usually confirm these 80-day cycle lows looking at the VTL. So you look at Bitcoin's 80-day high VTL to confirm an 80-day cycle low, or we can use a 20-day we can use a 20-day VTL too. It's not super reliable though. Problem is we have no VTLs now. So what I'm using to confirm this 80-day cycle low is actually the 80-day FLD. So it's a 20-day moving average, move it forward by 30 days. Crossing above that confirms that the last low before that crossover is an 80-day cycle low. We have that on April 7th. Just talked about that. April 7th was forecast to be a pretty significant turning point. It was a significant turning point across all asset classes, with some exceptions. So we have an 80-day cycle low here on April 7th, way overdue. But it's not actually way overdue. I think it was actually came right on time, I think. I haven't actually measured this. Probably 80 days. Yeah, 88 days. So right on time. But it's not way overdue. I like to say way overdue because this sell-off felt, even though it wasn't that significant, it felt quite painful. It was painful on the altcoins, but not on Bitcoin. So right on time, exactly as forecast, within 8 days of the ideal low on April 7. That's an 80-day cycle low, already confirmed. I do think this is a 16-month low also. And if you remember, I do actually use color coding for these VTLs when it comes to crypto, which is, again, as you know, this is what I trade the most. And these black lines represent 16-month cycle VTLs. Now, I pay a lot of attention to those because, well, crypto only has like it's basically 15-year price history. That's all we've had in crypto. And we have had 3 prior crossovers of these black lines, of these 16-month low VTLs. All 3 lined up with bear markets. So to me, I call this a bear market indicator. The 16-month low VTL in crypto is a bear market indicator. Any crypto asset that is below this indicator is undergoing, this line is undergoing a bear market. Notice that Bitcoin has stayed above it. So that's quite important. We went over this in March. Solana and Ethereum, these are two market leaders. They're both way below. Not only did they cross the 16-month low VTL, they're way below. They crossed in February and they bottomed in April. So that's more than confirmed as a crossover. These assets are not looking good, especially Ethereum. We discussed last month how, yeah, maybe doubles from the low. It went even lower. This was late March. I think it was 2000. Then it went to 1500. That's another 25% sell off, another 25% sell off. And now from 1500, sure, maybe it goes to 3000. It won't change the trend. I'm pretty convinced that Solana, Ethereum, and a bunch of others have already topped out for this 4-year cycle. That doesn't matter as long as Bitcoin remains strong. And Bitcoin has remained somewhat strong. I would say weaker than in previous bull markets, but stronger than the rest, definitely. So stronger than the its altcoin peers, if we can call them that. Now the dash line, this one is an unconfirmed 16-month VTL. Why is that important? Well, it's important because even if there was one time when we had a candidate for a 16-month VTL that was refuted. It was not confirmed as a 16-month VTL. And yet what I learned is that you should still draw it anyways. So even though this dashed line is not a real 16-month VTL, if Bitcoin were to cross below it, that will be pretty significant regardless. So this is something to keep in your charts as well, in my opinion. So you have this confirmed 16-month low on September 6, 2024, and then we have an unconfirmed low on April 6, on April 7, 2025. You connect those two lows, that eventually, I believe, because I don't think this will happen, I think Bitcoin rallies, my base case, Bitcoin rallies to at least 100,000 and possibly beyond. By the time it goes to 100,000, this should happen by June, early to mid-June. When that happens, we're probably going to be able to confirm April 7 as a 16-month low. But until we do, you can still draw this VTL because if prices fall below, it's pretty negative. And so any longs you took, you can use this as an exit. That's what I'm doing personally. I bought some Bitcoin at the $85,000 level and then some more because I had some calls outstanding at 90K. It's like a 20% of a position for me. I'm not loading up yet. I want the market to prove itself first. I'm not convinced that I will only load up on Bitcoin if it goes to a new all-time high. Because if it goes to a new all-time high, if it crosses above this 16-month high, then it's probably going to at least 150,000. Then I would want a full position. I don't want a full position now, but I can dip my toes in the market. I can have 20 to 30% position as we wait to see if it has enough strength to go to a new all-time high. Now, based on the classic 4-year cycle pattern, yes, it should absolutely go to a new all-time high. The high on Bitcoin, notice that if it doesn't do that, if Bitcoin does not go to a new all-time high, then the high took place in January. There's a double top on the 80-day cycle, which is highly unusual. I believe this is the first time that would happen, that a 4-year cycle ends as a double top on the 80-day cycle. That might be too in the weeds, doesn't matter, it can still happen. But it would be highly unusual because technically the 4-year cycle would have ended in late 2024. That's too early. Again, yes, there's technically a double top to that. And so we do have a high in 2025, but it's on January 21st. The actual high is Trump inauguration day, January 20th. That's the actual all-time intraday high on Bitcoin right now. January of 2025. That's about 11 months too early. So 10 to 11 months too early. I don't think our base case should not be that that's a 4-year top, even though it definitely is a 4-year top on some altcoins. Like it's definitely a high on Ethereum. In fact, Ethereum has the most unusual pattern. We have a double top on a 16-month cycle. We've seen those before, but the cycle ended extremely early. It ended in December 24. Solana, same thing, double top on the 80-day cycle, which is also a double top to its last 4-year top on November 21. And yes, I do believe this cycle has ended. This 4-year cycle has ended. But Solana is unusual. The bull market started in late 2022, but for Solana, Solana's bull market started, but it started the run started in September 23. The first year of the bull market, as Bitcoin was already surging higher, this thing was doing nothing. This is 2023 on Solana, nothing, just a bunch of sideways move. The point I'm trying to make is these 4-year cycles are most visible on the most liquid crypto asset. The altcoins don't really matter. You can still draw these VTLs. They do have a 4-year cycle, but it can deviate from the norm, from the normal pattern by a lot, depending on the name. So I'm comfortable saying Solana has topped out on its 4-year cycle. I'm comfortable saying Ethereum has topped out on its 4-year cycle. But when it comes to Bitcoin, I just don't see it. It's just too early, which means I'm not convinced it goes to 150,000, but it's my base case. Now, if you asked me 12 months ago, do I think, last year you asked me, when do I think this bull market ends? I would say 90% chance this bull market ends in November of 2025. If you ask me now, I would say it's a 50-50 shot. There's a 50% chance we go for new all-time highs in November. There's also a 50% chance, yeah, the high was back in January. Why am I saying that? Well, because a bunch of altcoins have topped out. And usually these move together. They don't diverge by that much. Now, maybe the market is changing, maybe the market is maturing, maybe capital is flowing into Bitcoin and flowing out of altcoins. That all makes sense to me, but I'll believe it when I see it. So for now, it's a confusing time because already we have significant deviations from the classic 4-year cycle pattern on crypto. But I would say, even if we take into account those deviations, if we just look at the cycle picture, Bitcoin is poised to make new all-time highs as we head into the likely top for this bull market in November of this year, late November, maybe as late as December. That's still my base case. Now, I don't think it will follow the classic 4-year cycle pattern in terms of the magnitude of the move. I don't think it goes beyond 150,000. I think even if it goes for an all-time high, it's not going to be significant. It's going to be 150, 160K. I don't think it goes beyond that. Let me read some of your questions because I don't want to get too ahead of myself. I put a lot of time implementing the corrections sent back about the course. I'm glad they can be used. Perry, yeah, thanks for that, by the way. Yeah, I'm sending that to the guy also. I'm going to take the opportunity. We're not going to do corrections on the first 3 lessons, but we're going to do corrections on the lessons 4 through 9. So thanks for that. Is silver going to follow gold? We can go over silver if you want, but I don't really trade silver. It's like when they were saying, I don't know if you remember this, Perry, but people were saying back in the day that Litecoin is it's like silver to Bitcoin's gold. And I was like, that makes no sense to me. And besides, why would I trade silver? I can just trade gold. I feel the same way about silver. Let me go over it real quick. Again, I don't trade this one very much, mostly because you don't. Come on, what's the symbol? SL? I don't even remember the. Well, let's use the ETF. So is silver gonna follow gold higher? Possibly. I mean, I'd be interested to see if it made a 7-year cycle low. It did. Clearly a 7-year cycle low here. But what I keep hearing about people about silver when people talk about it is that it's just not as strong as gold is. So in my opinion, nothing can outshine gold, and certainly not silver. This is just my opinion, but I would not trade silver as a proxy to gold, especially with the mini gold futures. You can trade gold ETFs on leverage Gold stocks maybe are a better proxy. Um, any cycle analysis, I mean, just clearly here, there's a lot more noise on this one. The 20-week cycle indicator is going crazy, indicating that this 20-week cycle in silver is a lot more pronounced. Whereas in gold, it's just like a smooth line higher. That I've seen before. I mean, I used to trade both gold and silver, eventually gravitated toward gold because I'm not much of a short-term swing trader. So I wasn't really, I didn't care for these swings within that 20-week cycle. Prefer to trade gold's very smooth uptrends. I mean, the charts look different, even though directionally they are following the same pattern. I don't think anything can outshine gold. I don't think there's a better proxy for gold than gold itself. So that would be my very quick and dirty analysis. I just don't pay much attention to this. Now, again, I can see that it has the same cycles. I can see the 18-month low here, 18-month high here. And yes, guys, I've been doing this for so long, I don't even need indicators to face cycles. I can just look at it. There appears to be, maybe, this could be an 18-month high, but it's unconfirmed. I'd like to see a lower high on this 20-week cycle. So, you could use silver to confirm a cycle on gold, knowing that they're lined up and silver is more cyclical. I do this with Ethereum sometimes versus Bitcoin. If I can't quite confirm a cycle on Bitcoin, sometimes I look at Ethereum because Ethereum is more cyclical than Bitcoin. Its cycles are more pronounced, so they stand out more. And sometimes that helps you face when you're in doubt, you can just look at and just by analogy, just try to figure out what the cycle picture is looking at for your benchmark using other assets as a proxy. So the only use I find for silver, it is more because these cycles are more pronounced. I think you can use it to get a better sense of what gold might be doing. And yeah, what I can say here is that it looks like silver. I'm not saying this is confirmed, but I would say it kind of looks like it topped out on the 18-month cycle in October 24. And if silver were to fall below this 20-week cycle low, I would say, okay, that 18-month cycle has topped out. We have a double top between October 24 and April. Remember, April is important for gold. And so we could use that as a confirmation tool for saying, okay, gold is definitely topping out, even if it's not entirely clear that gold has topped out, because maybe by then gold has barely fallen. Maybe it's still about 3,000, but silver's trading for 26. If I see that setup, I would say, okay, we probably do have an 18-month cycle high on gold, but I would not trade, I would not use silver as like a high leverage play on gold because that's not really what it is. I mean, yeah, it's high leverage, maybe exaggerates the moves higher, but it exaggerates the moves lower too. There's just a lot more volatility on this asset. And I think gold is a pure monetary asset, whereas silver is more of an industrial asset, an industrial commodity. So, yeah, I mean, if you're a short-term trader, my scalping strategy that uses a very short-term cycle, uh, could probably set up a strategy to trade a 10-day cycle in silver. It probably works wonders because it's very cyclical. I can see that. I can see the potential. But for a trend following strategy, yeah, I'm not a big fan of this one. Let's go back to crypto. All right, so is silver following gold? Like how altcoins typically follow Bitcoin? I think I answered that question. Yes and no. Bitcoin's pattern. I mean, there is a similarity between Bitcoin and gold, and let's say Ethereum and silver, because Bitcoin's uptrends and trends in general tend to be a lot smoother than other crypto assets, whereas other crypto assets, other altcoins tend to be more cyclical. You can see the shorter term cycles; they are more pronounced. You see the same thing between gold and silver. However, even though from a cyclical point of view, it's remarkable to see such clear 20-week cycles in silver, it's actually it's not a feature. That's more of a bug if you're trying to trade with a trend following strategy. I mean, just remember what silver looks like. It looks like this. Look at all these 20-week cycles. It can whip you around. It can get you to exit a position too prematurely, or maybe you're taking too much heat on those trades. Whereas if you trade gold, it's just smooth sailing. It's smooth. So I like this chart. This is the type of chart that I like to trade. Whereas, again, I find these remarkable because that 20-week cycle in silver is incredible. It just jumps at you. That's phenomenal, but it doesn't make for a great trading game. That's the problem. So, okay, so trading gold is like easy mode training compared to other sectors. Yes, Perry, it's so easy. It's so easy. I mean, the problem with gold is that it goes through these, because when the 7-year cycle turns down, that's like a 3-year bear market. Between August 11 and I think it was December 2015, gold was undergoing it was a it's a 14-year cycle. Yeah, it's a 14-year cycle correction. So that's 5 years where you can't do anything. But once it gets going, it's amazing. It's the smoothest uptrend you can hope for. Silver is more of an industrial metal instead of financial, exactly, which makes it more cyclical. I believe that the reason this 20-week cycle is more pronounced in silver is there's probably a short-term industrial component to demand for this commodity, and that's why you see those sharp moves in silver. That's just a wild guess, though. Do you ever overlay the two tickers, such as silver and gold, together? Yeah, I do. I do that a lot, actually. That's just case in point for how much better gold is. Gotta do this. You line them up at the low. If you line them up here, come on, why is it unloading? This is not gold. Ah, Python. No, this. There we go. Okay. So too many lines, but yeah, I actually do this type of stuff a lot. Change this to a line. There we go. Change the, you can see how, whereas gold is just a smooth line, this is the 7-year low. This is the 7-year low right there on both commodities, and silver's just doing this as it moves higher. Whereas gold is, yeah, it has its waves, but you can clearly see here that of the two commodities, gold has by far the best trend. So that's where I would deploy my monies, where it's easier to trade. You want to make life easier for you, not harder. I mean, actually, it took me years to learn that as a trader. Is that you want to make things easy, not complicated. Do not overthink this. Just create a simple strategy and go with it. The strategies that I use, for example, on the hyperliquid trading pools, the entry is the same for all strategies. I mean, some of them get a little more complex. Typically, just looking for a cycle breakout. 5-day cycle breakout, buy. 20-day cycle breakout, buy. 80-day cycle breakout, buy. And I call these, position, swing, and scalping strategies because the 80-day cycle doesn't have that many breakouts to the upside as compared to the 5-day cycle, which has a breakout every other month, actually every other week. So you have a lot of trades with the 5-day strategy, but these are short term. So scalping, 20 days position swing. It's a trade you'll hold for a couple of months. 80 days, you may be holding on to that trade for years. So that's what defines the time frame for the trading strategy. But the trigger to enter the market is always the same. It's a breakout. Very simple. A single close above the last cycle high. That's it. And it works. So, if it ain't broke, don't fix it. All right, let's move on. I hate using line charts. I only use them when I'm comparing symbols, like candles. And let's bring back these two guys. All right, so there's not much of a multiplier. Question from Perry, there's not much of a multiplier left on BTC, 2x at best. So can't there still be a better return on many alts? Yes, I actually wanted to touch on that. So let's go back to Bitcoin. And the Bitcoin multiplier based on the 60-month low on this bull market is about 2x, like Perry just said there. It doubles the price. So if the low is 80K, the high should be about 160K. The same is true here, or was true, um, in the last, with the last 16-month cycle low. So I had the low on September 6th. This is because that's the lowest close. If you look at the intraday low, though, if you look at these candles, the actual 16-month low, it took place on August 5. That's within a day of my forecasting model's forecast. I needed to say that because that was quite remarkable. That was the first time I was really wowed by this indicator, this forecasting indicator. Oh, what's happening with this regular? So you take the low at 50K and you double that, and the high should be 100K. That's pretty much exactly what happened. The high was about 100K. The exception to that was the 16-month low here in September 23. So this one I think tripled. I think the lowest, yeah, the lowest 25, the high is almost 75. So it tripled. It's a 200% return if you bought on the day of that low. Uh, an exception, not the rule. This one also doubled. So we have had so far, we've had three 16-month rallies in this bull market. And in two of those, we had a doubling of prices, 2x from the low. And in one of them, we had 3x. Now, the reason I'm dismissing this one, the 3x that we had in Q4 23 and Q1 2024, is because this was probably the most hopeful time we've had in this crypto bull market. In fact, between Q4 23 and Q1 24, Bitcoin was behaving the way it used to. It was a powerful uptrend. Funding rates were through the roof. Leverage was at all-time highs. Open interest on crypto derivatives, all-time highs. People are paying 50% annualized rates for borrowing stable coins, which is usually, that's what we used to see back in the day. That's what we used to see in crypto. So at this point in Q4 24, sorry, in Q4 23, Q1 24, this market is behaving like you would expect. So Bitcoin tripled its price from a low 25K to a high of about 75K. And even then, it was kind of premature. Tripling is, comparatively speaking, based on, if you look at past cycles, a 3x is not much in Bitcoin. I mean, I think post COVID, it did a 10x. So, but that was the best 16-month rally in history, even compared to 2017. So, or yeah, I think it was the best after 2013, because prior to 2013, Bitcoin was just bananas. But it would also crash by 80%. It would go up 20x and then crash by 80%. Very different asset. In modern Bitcoin trading history, though, which to me starts after 2015, these types of 16-month rallies where Bitcoin triples in price, that was the norm. So at this point, we're looking at a pretty normal bull market. So we start the rally here in September 23. We end the rally in March 24. Triple in price, normal bull market. The problem is, this is what happened next. We have an 8-month consolidation period. That's not normal. This is not normal. This is not normal at all. So this is an abnormal bull market, and it tends to be, sadly, it's abnormal in a negative way, meaning it's just not as strong as it used to be. So even though we did have one single classic 16-month rally, everything else about this bull market has been quite disappointing. So I tend to dismiss this. In my forecast, I don't think Bitcoin is going to triple its price from 80K. It will go to 240K. That's not really what we're looking at. And I'm going to unpack that in just a minute. Part of the reason why is, again, following this rally, we have this brutal correction. It wasn't brutal in terms of price. I think it went down 25%. That's nothing for Bitcoin. The problem is we top out in March, we break out in November. That's about 8 months. 8 months of nothing. That's very unusual. In fact, it's the first time we see that in a crypto bull market. Following that, Bitcoin doubles in price. on what's possibly one of the worst 16-month rallies in Bitcoin history. So this pattern of underwhelming based on historical examples continues to this day. So we have a very long, a very drawn out correction. Then we have one of the weakest rallies in Bitcoin history of the history of the 320-day cycle. Then we have another thing that's highly unusual. Why did I delete that line? Let me put it back up. So the most unusual thing to happen, or actually it's just a long list of unusual things, but one of the unusual things that happened in this bull market is that Bitcoin came very close to its 16-month low VTL. Very, very close. Notice that on April 7, sure, it bottomed out on April 7, but it also, notice that the VTL was at 70K. Bitcoin touched 74K on April 7. It came within 10% of crossing below that bear market indicator. It has never done that. Usually in a crypto bull market, well, in the 2017 bull market, we didn't even have a 16-month VTL. We couldn't draw a VTL. I taught that on lesson 7. You can't find a 16-month cycle correction using the 16-month filter. That is remarkable. That means there's a very powerful trend going. But going beyond, going back further than 2015, Bitcoin would always stay far above its 16-month cycle VTL. Now we came within 10%, within about 5% of crossing below it. That is negative in and of itself, because what that means is that not only is the rally, the 320-day cycle rally, weak, its correction is relatively strong. So we have a weak rally. If we had a weak correction, that would just kind of, they would kind of cancel each other out. But no, we have a weak rally and a strong sell-off. This is a weak trend. It's a weak cycle that ended. It also ended prematurely. I think it's not even in, because remember the 60-month cycle comes from the 2020 bull market. If you look at the historical pattern, it's more of an 11-month cycle. That's about 320 days. This one was 214 days. So very weak, very short, just underwhelming all around. An underwhelming cycle. So this is why I'm thinking maybe we don't go for the all-time highs, just because this last 16-month cycle was extremely weak, extremely lackluster. Not only that, it's hard for me to see how Bitcoin triples from 80K up to 240K when oil is spelling out deflationary recession, the treasury market is wrecked, and the stock market is about to confirm a bear market. How is Bitcoin going to triple in this environment? I don't think it can. Now, can it double? I mean, sure, that's a base case. That's the least it can do. The least it can do is double. But if there was ever a time, let me put it this way, I would not be surprised if Bitcoin rallies to 110, 120K, and then it tops out, and it tops out in June, and it comes back down, it crosses below the black line, and that's it. Bear market on. I would not be surprised to see that, which is why I only have a 20% position right now in this market. It's because there's a lot of weakness out there within crypto and outside of crypto. A lot of weakness, whatever you see. So if there was ever a time when this Fourier cycle pattern is not going to unfold the way it usually does, I would say it's now. It's in 2025. We have already seen a series of underwhelming cycles on that critical 16-month cycle. And so from the long correction, the very long correction in the middle of 2024 to the extremely underwhelming rally following the low on September 24 to this relatively, I think this correction was actually stronger and faster than the one before. So notice that we have a 30% correction in the price of Bitcoin within a few months, whereas the prior correction was 8 months in duration, 6 months to reach a low, and it was less than 30%. So 6 months to sell off by about 30% versus a couple of months, and we're down the same amount And this following a rally that was extremely underwhelming. I mean, we hit the low. This is another unusual thing. I mean, look at this. I don't think this has ever happened before. So the fact that Bitcoin got this close, this green line, this is a 16-month high from March 24. And look how Bitcoin got, how close it got from testing that line. I think that's a first. I don't think that's ever happened before. So the fact alone, even though we're above this 16-month VTL, the fact is we got pretty close from crossing below it. We got pretty close from crossing below the high on the last 16-month high. These are all firsts, and these are all signs of weakness. So I would not be surprised if it just, maybe we go for a double top in June. Maybe we rally into June, double top, we go to 110, and that's it. And there are so many institutions involved in this asset now, and a bunch of them did not get their chance to sell 6-digit Bitcoin. So pretty sure that if we hit 100K, which I think is pretty much a given, but the next time we hit 100K, we're going to hit a correction. It's going to be significant. But so far, I'm leaning on, well, 100K is probably when we hit the next 80-day cycle top. For now, that's all I'm going to say. I think it's going to be an 80-day cycle high. If you look at the forecast that Perry shared here, you have it on the Discord, there is a high forecast for May 23. I think the next 80-day cycle top is going to be on or around May 23. And I would even go further and say I think the price is going to be between 100 and 110K. So it's going to be, 100K is the key psychological level. There's not actually that many closes above 100K, but it did go, Bitcoin did manage to go a little higher than that. So this is the highly sensitive area, 100 to 105, 110K. That's the area. That's by late May. I know that's a very specific and precise forecast. I'm prepared to be wrong, and I hope I'm wrong to the upside. I hope Bitcoin just blasts through 100K and goes to 150. I'll be very happy if that happens, but I would not be surprised if it doesn't. So if there's ever a time when this market is going to underwhelm, it will be now. And the reason I'm saying that is because it has already been extremely underwhelming, and that cannot be dismissed. Um, I see a lot of people out there thinking, well, the fact that this cycle, this 4-year cycle, has been so weak thus far means the best is yet to come. I see the opposite. I just see a weak cycle that's likely to get even weaker as we approach the date of the high. Maybe Bitcoin doesn't do what I think is going to do. Maybe it just trades sideways for a few months. And then by the time we reach the second half of the year, we're still below 100K. And then maybe goes to 100K, 110K in November. That's a top. That will be a double top to what happened in January. So we would have a double top between November and January. That satisfies the uh, the classic 4-year cycle pattern in terms of Bitcoin hitting the high in the November in Q4 of the year of the year of the high. That's usually what happens. The highs are always in Q4. So, but that doesn't mean it's going to be a 200K or 150K. That could be a retest of a level we've already seen. And when have we seen that before? In the last cycle. So last cycle, that's exactly what we saw. Sorry, this is just some testing I was doing, but that's what we saw in the last cycle. So this theme of having 4-year cycles that are weaker than they used to be, this goes back to the previous cycle. The previous cycle in 2021, that's the last time we saw something unusual. We saw Bitcoin hit a significant high in April, and that doesn't quite line up with a classic 4-year cycle because with the classic 4-year cycle, the high is in Q4. Well, the high was technically in Q4 of 2021. It was here, November 8th. That was the 4-year cycle high. But it's just a retest of a prior high, this one, the one in April. So see, April was too early for a 4-year cycle top. So we ended up having the 4-year cycle top in November. That lines up with the classic, with what you should expect. Was it a significantly higher high though? No, it was barely higher. I think it was I think we hit 69. No, it wasn't 69. 69 was the actual high. So we hit 65 in April, and then we have to wait until November for prices to get back up to the 60s, and we top out at about 69. So let's call it 70K. So we hit 65K in April. We crash or we contract sharply, then it rallies again and it hits a high slightly higher at 70K by November. Can the same thing happen now in 2025? Yeah, it can. Now, I will say back in 21, that crash that cleaned out a lot of leverage, a lot of speculators got cleaned out in May of 21. So the market just could not come back. Uh, in comparison, this correction we've had now in Q1 of this year is not being anything of the sort. I don't think a lot of people got cleaned out in this rally. Obviously, some people lost money. I'm sure they have. People buying around the highs in December and January, they probably lost money. But I wouldn't say the market got wiped the same way that it was. It was pretty dramatic. I don't know if any of you guys were trading back in 2021, in May of 2021. I actually, on my publication that I write every week, I called for a significant crash just based on the amount of leverage we had in the market going into that high in April. It was insane. I mean, I saw December. So this is March, right? This is a funny anecdote. Ethereum December futures were trading 25% higher than spot. That's not 25% annualized. That's 25% higher. So they were trading at 100% higher rate, annualized rate than spot. That was absolutely insane. Never seen that before. So I knew, because I trade a lot of leverage and I trade a lot of derivatives, I knew there was a lot of leverage built up in the market by Q1 of 2021. So I thought, okay, next time we hit a 60-month high, it's going to be pretty significant. And it was. What I didn't know, what I didn't realize at the time is that it cleaned out the market. The market was just not able to come back after that brutal sell-off. I don't think we have the same setup now in 2025. That's the good news. I don't think the market has been brutally cleaned out like it was in early 21. So is there enough dry powder to drive this market to new all-time highs to 150K? Oh yeah, I think definitely. I'm just worried about macro. I'm worried about trade wars, kinetic wars, liquidity being too weak, the Fed being reluctant to cut, the treasury market being broken. There's just too many signs of a broken economy by now. And I happen to know that it's very likely that we're going to have a global crisis in 26. So, yeah, tread with caution. I'm going to wrap up here, guys. I'm going to read the rest of your questions and then I got to run. This was super fun to do, as always. But that's actually all I had. The market is looking good. We might see $150,000 Bitcoin, but it's not a given. It's not a given. If you ask me again, if you asked me 12 months ago, even if you asked me back in August when we launched this service, I was a lot more bullish, and especially in Q1 24, because Q1 24 it was bull market on. It was a classic, lot of leverage. It was just this classic explosive crypto bull market that ended with this 8-month correction. That just ended and it never came back. I thought maybe we were going to come back after Trump won, and there was a lot of excitement around that. Liquidity was moving higher, but it ended with a whimper. And it's just, and now we're, you know, mid 90s again. It's just a weak market. Anyways, thank you, Juan. Great session. Margot, thank you so much. Had to head out for another meeting. I'll talk to you soon, Margot. So thank you for joining as always. Appreciate you being here. Perry, question. Was that consolidation abnormally long, 8 months, because the preceding rally was too early, too fast? I've seen that theory, Perry. Some people were saying, especially in Real Vision, they were saying, well, yeah, this is a classic rally. I don't disagree. I don't agree, by the way. I don't agree with that view. That seems like revisionism to me. They were saying, well, this rally is front loaded. Bitcoin hit an all-time high before the halving. And it's super unusual. That's highly bullish. And so we had an early rally. And of course, Bitcoin had to catch up to historical patterns. Nice theory, except if you fast forward another 12 months, now we're nowhere near where we should have been based on historical patterns. This thing is dramatically underperforming past 4 year cycles. Dramatically. And it's not even close at this point. It's not going to catch up. There's no rule saying that the market has to catch up to what it used to do. The folks at Real Vision specifically also, and by the way, I'm a GMI subscriber, Global Macro Investor. That's like the premium tier service. I love RAL. I love Real Vision. This is not a dig on them. I just don't agree with this view that it's like 2017. Their comparison, their benchmark is that this is like 2017 because that's the last time Trump was president. I'm sorry, I was trading in 2017. This is nothing like it. This is nothing like 2017. And no amount of time will make it like 2017. So no, I don't agree that this market was catching up or catching down to some previous cycle. I think each cycle is different in its own right. They're never the same. And this one was underwhelming. At the same time, I do think the next book, I think we're going to hit a 2008 style crisis. I don't know if it's going to be that bad. I just don't see how it can be that severe in the 26, 28 period. I think we're going to have a deflationary recession. Following that, we're going to see tons of money printing. We're going to have an explosive crypto bull market. So I think it's just this particular 4 year cycle was weak. I don't think crypto is going to start being weak from this point forward. I think this particular cycle was pretty bad. I think it will continue to underwhelm. I think it will continue to underperform historical analogs. I think the next bull market, though, is another question and another story entirely. And I do think that if we are in the midst of a global recession, by the time we hit the 4 year cycle low, then watch out because there's going to be a ton of money printing. And that's going to push the market way higher. And that's going to be more of a classic crypto bull market. But that's again, that's a story for the next bull market, and that's slated to begin in late 2026. So I'm not going to worry about what the next bull market looks like. I'm focused on this one. All right, so it's this market gets cleaned out. Who gets the money now? Exchanges, ETFs? Yeah, unfortunately, yes. I think the next time we hit a crypto bull market, a lot of retail are going to sell their Bitcoin into to Wall Street. I mean, they're really moving into the space, and never a good thing when Wall Street moves in. I think they increase liquidity, they make the market a lot more professional and transparent, but the opportunity is just not there. Now, again, I think that it's all about money printing and liquidity. Because, I mean, yes, global liquidity is important. But within global liquidity, what's most important specifically is whether or not two central banks are printing money. One is the Chinese, the other is the Federal Reserve. If China and the Fed are printing, it's bull market on, baby. And it's explosive. It's what you're used to seeing. It's 10x Bitcoin price appreciation within a few months. That's the type of bull market that I like to trade. I don't think it's coming now because the Fed is not in the game. It's just the Chinese. It's just the Chinese that are printing. The Chinese are printing money. That gave you this. That gave you one of the worst bull markets in crypto history because the Fed is not there. The Fed might come around to easing again if the Treasury market cracks. The problem is if the Treasury market cracks, you're going to have a massive crisis. And then they're going to have to start printing again. So again, it's a story for the next bull market. Where was I going with this? So watch the Treasury market, I guess, because I lost my train of thought. Um, oh yeah, the yuan. This is the problem that I see right now. So the Fed is too tight and the yuan is too weak, which means the Chinese can't print. This is where we are right now. This is these two red lines. I watch these all the time. It's the 7.3 to 7.35 level on the yuan dollar exchange rate. This is probably the most important FX pair in the world right now. It's the Chinese currency to the US currency. So China needs to print. They have a massive housing bubble. I think it's estimated at $50 trillion. That's twice the size of the 2008 global financial crisis. So it's a big problem. And the only way to they can't fix the housing sector, but the banks are all exposed to housing. So all the banks are bust. How do you how do you get out of that situation? Well, you need to print a lot of money. The problem is in this situation where the dollar rates are too high and the dollar liquidity is too tight, if the Chinese print, the Chinese currency suffers. That brings in inflation and a whole host of political issues for the Chinese Communist Party. So they can't print money, basically. They can't print. Their hands are tied. They want to print, but they can't. Now they have been easing recently. And notice that even though, by the way, when this chart goes down, that means the Chinese currency is getting stronger. So look at what the yen is doing, for example, over the last few months, up strongly. So when this chart goes down, dollar is down. So the yen strong against the dollar. The euro very strong against the dollar. The pound strong against the dollar. The Chinese yuan, nope, it's weak. So what is this telling us? What it's telling us is that every time there's a little bit of dollar weakness, the Chinese print money and they ease. That's good for crypto. The problem is they hit this ceiling at 7.3 to 7.35 and they stop printing when they hit that ceiling. So their hands are tied. They need to print, but they can't because they don't want to devalue their currency. So the People's Bank of China can't ease unless the Fed eases. And the Fed is just unwilling. The Fed is unwilling to cut rates and ease financial conditions in any significant way. They do just enough to keep things run, to keep the lights on, to keep the financial system going, but they stop at being too aggressive. They don't want to be too aggressive. I think they will maintain this stance until we hit a crisis. Jay Powell and the Fed, they're probably going to be blamed for that crisis. People are going to say they're too late. They probably are going to be too late. My view is they were late with inflation. They're going to be late with deflation. These guys are just late. That's what they do. And again, that's what Trump says, and I do agree with him on that. Jay Powell should be a lot more proactive in easing a lot of liquidity now, but he's not. So Chinese can print, that hurts the liquidity, hurts crypto. The Fed doesn't want to print, it hurts crypto. So is Bitcoin going to go to 240K? Probably not. I mean, is this bull market about to get explosive? Probably not. Is the Fed going to cut rates? Yes. But is the Fed going to cut rates before or after we hit a recession? My money is after. They're going to cut aggressively when things get much worse from where we are now. Why? Because the Fed is late. I can kind of see why they don't want to cut. They're probably going to be seen as helping the administration. I don't think they want to do that. I can kind of see how you could make the case that tariffs are going to be inflationary and a trade war could be inflationary. Honestly, if a trade war kills global trade, it's going to be deflationary. And that's how they should be reading it. But yeah, I think this Fed is just too political. They got super aggressive with inflation. There were rumors that they were being pressured by the White House to fight inflation, so they started getting hawkish on inflation. And now there are rumors again that Jay Powell doesn't quite like the current administration. He doesn't want to help them. And so again, he's playing politics. He's going to be late. And so it's not his fault. It's not the Fed's fault that we're heading into recession. But the fact is, we're probably heading into recession. They should be helping, not hurting or hindering. But this is just my read right now. This is just a sense that I have. It's just an intuition. I can't point to anything specifically, other than the fact that we should expect a significant high across global markets this year, and it could be the Fed that's just unwilling to come to the table and ease the way in the amount that they need to ease in order to calm markets down. All right, so okay. So perhaps leverage for trade negotiations, all print when deal is made. The problem SL with the trade negotiations is it's not the tariffs themselves, it's the flip-flopping, and most importantly, I think it's the uncertainty. It's the uncertainty that's hurting the global economy right now. It's not really whether the tariff is 150% or 250% or it's going to come down to 60%. Trump said recently it's not going to be. He literally said it's not going to be 145%. Okay, we all know that. But what's it going to be? Nobody knows. In the meantime, nobody invests, nobody commits, and capital doesn't move. which is what the economy needs to keep growing. Is capital needs to flow. Capital is not flowing right now because of the uncertainty. So yes, we know there's going to be some negotiation, some deal is going to be made, but we don't know what it looks like. We don't know when it's going to happen. And until it does, no one's going to do anything. Meanwhile, the global economy rolls over. So again, I don't think it's a story for the first half of this year. This is a story for the second half, but it's coming. So again, and within this context, I think we'll be lucky to see $150,000 Bitcoin. We'll be lucky if we see it, but I don't think we're going to see more than that. All right, so those recent bond inversion events still also indicate recession too, at least according to history. Yeah, agreed, Perry. The way the bond market is trading, yeah, it indicates deflation. It means there's a shortage of bonds. People are selling bonds. It could either be capital leaving the United States, or it could also be the fact that there's not enough global liquidity. There's not enough dollar liquidity in the globe. And so people are selling their main source of dollars, which is the treasury market. And there's a link between global trade and the treasury market too. Foreigners hold their dollars mostly in treasuries. If there's no trading going on, I mean, how do these foreigners get dollars? Well, they get dollars by selling stuff to the United States and other countries. If global trade stops, and these countries need continue to have to service their debts, they start selling dollar assets. First thing they sell is treasuries. Actually, the first thing they sell is stocks, then they move on to the treasury market. Either way you cut it, we're seeing signs of recession. We're seeing signs of stress in the financial system. And so, yeah, this all means we're likely heading into recession. I keep trying to paint two pictures. There's a medium-term picture, which is bullish and constructive in crypto. I think we hit at least 100K in Bitcoin. That's only $5,000 more from where we are. I think there's a very good chance we hit a new all-time high. That's a short to medium term picture. Long-term picture is it could not be worse. We're probably gonna hit the next crypto bear market is probably gonna be a bad one. Um, I want to be in cash for that one because I also want to buy the low. Now, the bear market is particularly bad because all of the financial system is hurting. That means the amount of money printing that's going to be necessary to bail the global economy out of that crisis is going to be massive. It's going to be higher. It's going to be more than COVID. It's going to be more than 2008. It's going to be tens of trillions of dollars. Maybe that's too much, but it's going to be a lot of trillions, many trillions. I don't know how many. But it's going to be enough to give a significant boost um, to liquidity sensitive assets like gold and like Bitcoin. And even if you look at the cycle picture with gold, we know that gold is scheduled to run at least until 2028 based on that 7-year cycle. So there's a lot of money moving into gold. And so we know there's going to be in a bull market. Gold is also a liquidity sensitive asset. So we know that gold is generally undergoing this massive bull run. And so that tells you that crypto should probably follow suit, especially Bitcoin. So after this coming bear market, we're probably going to see another classic, 3 year, 3 years up, 1 year down, 4 year cycle. But I think the next one's going to be, quite significant. I think the next one might take us deep into 6 digits. I'm talking 300,000, maybe $500,000 per Bitcoin, but that's years down the road, maybe 4 years down the road. All right. With all of that, I have to wrap up here. This was fun as always. Thank you for your questions. Thank you for showing up. You make my day as always. I have more announcements to make over the next few weeks as I'm building up to bring in more people into a little group. But until then, I'll see you all in the next one. Ciao, everybody.